Welcome to the Deep Dive. Today we are taking on a market that is, well, just massive. It's essential, historically pretty opaque, and we often overlook its digital revolution. We're talking about fixed income trading, the global bond market.
It is a phenomenal topic. I mean, you're looking at a universe of debt over $123 trillion globally. It's staggering. And for decades, if you were an institutional investor trading bonds, you picked up the phone. Seriously. It was manual, fragmented, pretty inefficient.
Right.
Now that entire workflow is undergoing this huge shift. We call it electronification. And this structural shift is probably one of the most powerful secular trends in finance right now.
And sitting right at the start of all this, well, that's our focus company today, MarketAxess, ticker MKTX. They started way back in 2000. They were, truly the vanguard here.
Absolutely. They applied technology to connect this huge global network. We're talking over 2,000 institutional investors and broker-dealer firms.
And the basic idea, their foundational purpose, was just to cut transaction costs. And importantly, to somehow systematically manufacture liquidity in what was fundamentally an illiquid market.
Yeah, they essentially built the first real digitized trading floor for credit products, which, had resisted automation for much, much longer than equities or futures ever did.
Right. But here's the puzzle. Here's the dilemma we really need to crack for you today. MKTX, historically the dominant player, the pioneer who capitalized hugely on this trend. Well, today, they're seeing significant market share erosion and, crucially, profit pressure. So our mission is to understand exactly why this dominant player is struggling. And, maybe more importantly, can their recent pretty aggressive strategic pivot actually return this foundational company to high growth, get back that high premium valuation trajectory?
It's a classic story, isn't it? The revolutionary becomes the incumbent, and all the challenges that brings with it.
Okay, so let's unpack this ecosystem first. Before we get into the competitive war, we need to understand the machine MKTX actually built. It's a full-cycle value proposition, right? Covers everything from pre-trade data all the way through execution and even post-trade services.
Yeah, it's an entire trading environment. And it's all built on their patented technology. What's really crucial to grasp, I think, is that MKTX isn't just an execution venue. It's more like a data and intelligence platform that also happens to let you trade.
Ah, interesting way to put it.
Well, look at their next-gen trading interface, X Pro. It really embodies this integration. It's designed to give traders the intel, the actionable insights, to execute faster, smarter. It seamlessly integrates their proprietary AI-powered analytics and that pre-trade data.
Okay, you mentioned intelligence, and that's key because
Yeah.
their revenue engine, well, it's got multiple parts, but historically, it's leaned very heavily on one pillar, commissions.
Commissions are absolutely the dominant driver, no question. This revenue comes from transaction fees based on the notional value of the bonds traded. And the reliance is pretty staggering.
Yeah.
Just look at Q2 2025 numbers. MKTX reported a record $191.8 million in commission revenue.
Wow.
Yeah, and that represented about 87% of their total revenue. So you see, that heavy reliance makes them fundamentally sensitive to trading volumes, market volatility. If the market seizes up, their core revenue stream takes an immediate, very serious hit.
Which explains exactly why those other two segments, information services and post-trade services, are so strategically critical. Even if they are much smaller today, they bring stability.
Precisely. Information services that contributed about $13.1 million in Q2 2025. That's their stable subscription-based asset. And this is where you find their crown jewel. Composite plus Air, or CP plus Air.
CP plus Air.
This isn't just a data feed. It's an AI-powered predictive pricing engine. It gives real-time indicative pricing for, I think, over 32,000 global credit and rate securities now. Think of it like the most sophisticated GPS for bond prices. It guides traders to the best possible execution price before they even start the trade.
So, classic financial market infrastructure playbook, right? Execute the trades, then turn that aggregated data into a super valuable recurring subscription product, CP plus DIT2. And it sounds like they're explicitly trying to grow these stable subscription revenues to mitigate that extreme cyclicality of the core trading commissions.
That strategic evolution is absolutely necessary. But the way they built their core liquidity moat, the foundation of MKTX, well, that's fundamentally different from the old legacy systems, and that's open trading.
Okay, let's talk about open trading. The protocol, this is their flagship system, right? For years, it's been their key competitive differentiator. So describe how this actually works. Why was it so revolutionary?
Okay, open trading is revolutionary because it's all-to-all. The old way, the legacy system, was request for quote, or RFQ. An institutional investor would send a, quote, request, but maybe only to, their handful of trusted dealers. It was very restrictive, one-to-many transaction. Liquidity was captive to relationships.
Got it. Limited pool.
Exactly. Open trading just smashes that barrier. It allows any participant, doesn't matter if you're an asset manager, a hedge fund, or a dealer, to both provide liquidity and take liquidity anonymously.
It sounds like they basically created the world's first true, centralized, anonymous market for corporate debt, kind of bypassing that traditional dealer hierarchy.
Essentially, yes. And this structure creates an incredibly powerful network effect. The more participants that join, more buyers, more sellers, the deeper the liquidity pool becomes. Deeper liquidity leads to better price discovery, better execution, lower transaction costs.
Which in turn attracts even more participants.
Precisely. It reinforces the cycle, makes the platform even more attractive. And this dynamic, this has been their structural edge for years, especially in U.S. high-grade and high-yield corporate bonds.
And their product breadth is pretty extensive now, too, which must help diversify that liquidity mode. It's not just U.S. corporates anymore.
No, definitely not. They cover emerging markets debt. They just expanded into Indian government bonds, actually. That brings their local currency coverage to 30 markets, plus Eurobonds, munis, U.S. Treasuries. It's a truly global product suite now, and that helps them weather volatility if one particular sector goes quiet.
So if we zoom out a bit, the fundamental bullish story for MKTX, and really the whole electronic trading industry, is this electronification trend itself. We mentioned how huge the fixed income market is, over $123 trillion globally. The fact that this market is finally consistently moving digital, that's just an unstoppable, profound secular tailwind.
The momentum is absolutely undeniable. Look at the research. There was a JP Morgan survey in 2025. It found 100%, literally 100% of institutional traders expect electronic volume to just keep growing. But here's the fascinating part, the dichotomy. Despite years of growth, there's still substantial runway left. Massive opportunity remains.
Yeah, we can actually quantify that opportunity. Look at U.S. investment-grade bonds. Electronic penetration was, what, maybe 8% back in 2013?
Something like that, yeah. Tiny.
Now it's nearly 50% in 2024. U.S. high yield is around 45% penetrated. That's rapid growth, sure, but it means almost half the market is still done manually, by phone.
Exactly. And then you look at areas like emerging markets or municipal bonds. The penetration rate there is substantially lower, so the potential for new volume capture is just enormous.
Okay, so what actually drove this monumental shift away from the phone in the first place? What were the catalysts?
Well, we see two main drivers. First, you had structural changes forced by regulators. Second, advancements in technology and just changes in the market ecosystem itself.
Let's start with regulation. Because the changes post-2008 financial crisis, they were absolutely huge for the bond market structure.
Oh, they fundamentally upended the system. After the crisis, regulators slapped much stricter capital requirements on the big banks. This made it way more expensive for banks to use their own balance sheets to hold large inventories of bonds. Historically, banks were the market makers, right? They were always there to buy when you sold, sell when you got.
The shock absorbers.
Exactly. But when they were forced to shrink their inventory holdings, they essentially created this structural liquidity gap in the market.
Ah, okay. So when the traditional source of liquidity, the banks, pulled back, the market had to find new structural ways to connect buyers and sellers.
Exactly right. And this is the moment where all-to-all platforms like MKTX's Open Trading suddenly became indispensable. They offered a new, capital-efficient way to find counterparties without relying solely on a shrinking bank balance sheet. Plus, don't forget Trace. That was instituted way back in 2002.
Trace. That mandated post-trade transparency in the U.S. bond market, right? Reporting trades.
Yes, but how did that fuel electronic platforms? Well, Trace created the data. Before Trace, trading was super opaque. You often didn't know the exact price others just paid. Trace provided those crucial data points, which were immediately fed into algorithms and proprietary pricing models, like MKTX's CP Plus set.
Got it. Without that mandated transparency, the sophisticated analytics that really drive e-trading, they just couldn't exist.
Precisely. Transparency breeds data. Data enables automation. It's a virtuous cycle. And then on the technology and ecosystem side, you also have the massive growth of fixed income ETFs.
Right, the ETF boom. How did that play in?
ETFs are a really potent modern driver. Think about it. When a large institutional investor needs to create or redeem shares of a fixed income ETF, they often have to simultaneously trade a large diversified basket of the underlying bonds.
Okay. Lots of bonds at once.
Yeah, and this execution is highly automated. It relies heavily on specific electronic protocols designed for bulk trading. We call it portfolio trading. This flow provides consistent, high-volume activity for the platforms capable of handling it efficiently.
Okay, here. This is where it gets really interesting. And I think this is the aha moment that defines MKTX's current dilemma. The electronification trend, it's a rising tide, yes.
Yeah.
But the structure of that tide, the competitive landscape, is changing. The addressable market is fragmenting. And MKTX's historical dominance, it's getting squeezed.
Yeah, that's the core issue. We're seeing rapid growth in two specific electronic protocols that are basically eating away at the relevance of the traditional request for, quote, RFQ, which, as we said, was MKTX's historical core strength.
Okay, we established RFQ as that single bond, one-to-many request. So what are the two protocols squeezing it?
Okay, on one end, you've got portfolio trading. This is for those large, complex, multi-bond baskets we just talked about. It's growing super fast, now accounts for maybe 5% of total volume. On the other end, you have automated algorithmic trading, often called AutoX. This is used for the smaller, most liquid, easiest to price trades, quick in, quick out. And MKTX is actually a player here. They execute about 25% of their total credit trades via automation already.
So the implication here is pretty profound. The traditional human-mediated RFQ protocol, where MKTX really made its name, it's being compressed from both sides.
Exactly. The big, bespoke, complex trades are moving towards the bulk efficiency of portfolio trading, and the small, easy, liquid trades are moving to instantaneous, no-touch automation.
The middle ground, the traditional RFQ sweet spot, is shrinking.
It's shrinking fast. The value proposition of a traditional RFQ is diminishing because, well, if a trade is small and liquid, AutoX is faster and cheaper. If the trade is large and complex, portfolio trading is just vastly more efficient for managing execution risk across the whole basket. MKTX is, arguably, the undisputed champion of that shrinking middle, and that is the core structural headwind they're facing right now.
So if MKTX was the pioneer here, why did they kind of let competitors capture dominance in these fast-growing, flanking protocols like portfolio trading? Was it maybe a failure to anticipate where electronification was ultimately headed?
That is the multi-billion-dollar question, isn't it? Part of it is probably organizational momentum. They were so successful optimizing that all-to-all RFQ model. Maybe they became too focused on defending that turf, rather than rapidly allocating resources to these adjacent, arguably disruptive protocols. But now, well, that fragmentation is translating directly into quantifiable market share losses.
Which brings us to the numbers. This is where the competition has really drawn blood, especially in that crucial U.S. credit market.
Yes, let's look at the data. In U.S. high-grade credit, MKTX's share fell pretty significantly. It dropped from about 20.9% in Q4 2023 down to 17.0% in February 2025, a nearly 4-point drop in just over a year. That's massive in this industry.
And their CEO even admitted it, right? Said they were not pleased.
He did, which is rare candor in this space. And U.S. high yield, which typically commands higher fees, similar pressure. Share dropped to 11.1% in February 2025. That's the lowest level for that segment since late 2019. So the market is clearly questioning the durability of their core liquidity moat.
We should note, though, to be balanced, there are areas of counter strength. MKTX still holds pretty strong positions in markets with lower electronification penetration.
That's true. Emerging markets, Eurobonds, municipal bonds, they're doing better there. For instance, their muni average daily volume surged 41% in February 2025. That significantly outpaced the growth rate of their U.S. credit business.
So that diversification provides a bit of a cushion, but the main battleground, the most profitable and largest flow, that's still U.S. credit.
Definitely. And here, MKTX relies on its pure, deep, all-to-all liquidity strength from open trading. But their rivals, they're leveraging different and perhaps currently superior forms of competitive advantage.
Okay, let's break down the key competitors. Start with Tradeweb TW. They're consistently cited as the really formidable one.
Tradeweb's strength comes from, well, history and technology integration. They were historically dominant in rates products, U.S. treasuries, interest rate swaps. That gave them deep roots on trading desks. They successfully leveraged that dominance, that client base, to push hard into credit. But their real moat now seems to be integration.
Integration. How does that work in practice? What does that mean for a trader?
Okay, so Tradeweb has built a very strong portfolio trading platform, that's true. But their real power, arguably, lies in their deep proprietary integration with the buy-side's core systems, specifically order and execution management systems, or OMSEMs. The standout example everyone talks about is their deep integration with BlackRock's Aladdin platform, which, is used by institutional investors globally as their primary operating system for everything.
Okay, so if a trader is already inside Aladdin, their main tool for the day, and TradeWeb is right there, the default option integrated directly into that workflow.
Then MKTX is forcing that trader to open a whole separate browser window, a different interface, just to check a competing quote. The switching cost, even if small, becomes an operational friction point. TradeWeb wins by being the path of least resistance. That's workflow dominance.
Okay, workflow dominance. Then you have the other major threat, which seems totally unique. Less about execution efficiency, more about information dominance. Bloomberg.
Bloomberg is an entirely different beast altogether. Their trading platform, you could argue, is almost secondary. Their primary moat is the Bloomberg terminal. It's ubiquitous. Over 325,000 users globally. The terminal is the central nervous system of the financial world. It dominates the pre-trade stage, where traders get their news, their data, their analytics, their communication tools like chat.
Right, so the trader's already living inside the Bloomberg world for like 90% of their day anyway.
Yeah.
Checking credit curves, chatting with counterparties. So trading is literally just another button, another function seamlessly integrated on the terminal.
Exactly. Bloomberg wins by dominating that pre-trade decision-making process and embedding the execution tool right where the user already lives and works. This environment fundamentally shifts the competitive landscape. It raises a critical question. Is a fight purely based on sheer liquidity depth MKTX's open trading advantage? Is that still enough when your competitors dominate the decision-making stage like Bloomberg or the final settlement workflow like TradeWeb?
It really seems clear the competitive mode itself has fundamentally shifted. It's not just a fight for liquidity anymore. It's evolved into this fight for workflow integration. Competitors are winning by embedding themselves earlier in the process, Bloomberg in pre-trade or later TradeWeb and post-trade and OMS. MKTX is now forced to compete across the entire trading lifecycle. That requires a much wider, probably more capital-intensive strategic defense than just having the deepest liquidity pool.
And that shift in competitive focus has had clear, pretty immediate consequences on MKTX's financial performance. Specifically, it's accelerating the deceleration of their growth and really pressuring profitability.
Yeah, historically, MKTX was a fantastic grower. Revenue doubled over a decade, easily. But we've seen this dramatic deceleration since that 2020 pandemic peak. Growth hit almost 35% in 2020, but slowed dramatically to just 4.9% in 2023. And critically, net income has been basically flat since its 2020 peak of around $299 million. The volume is still going up, but the revenue leverage just seems gone.
And this brings us right to the single most critical profitability metric, the one that explains why the stock has come under so much pressure, the fee per million, or FPM. This represents the average commission MKTX earns for every $1 million traded on their platform.
And the FPM is falling, consistently falling. For total credit, the preliminary FPM fell from, $160 down to $143 in just 1 year. That's a big drop.
Yeah.
Why is this happening if the overall trend of electronification, that rising tide, is still in their favor?
This is the painful reality of what we call the negative protocol mix shift. MKTX's successful volume growth is disproportionately coming from protocols that are structurally lower fee. Specifically, growth is accelerating in things like portfolio trading and that automated AutoX flow. Meanwhile, activity is decelerating or maybe just staying flat in the higher fee markets, especially that traditional U.S. high-yield RFQ.
Can you help quantify that difference? Why is portfolio trading inherently lower fee than a traditional RFQ trade?
Sure. It boils down to efficiency and risk. If a trader uses RFQ to buy, say, 100 different bonds individually, MKTX charges 100 separate standard commissions. That reflects the time, the human intervention, the risks involved in sourcing liquidity for each specific bond. With portfolio trading, the trader executes all 100 of those bonds in a single click. The platform absorbs that entire block risk, manages the execution instantly across the basket. Because the platform provides such immense efficiency and scalability, the ability to move bulk inventory quickly, the per-bond commission rate has to be structurally discounted. They have to charge less per unit to win that large bulk volume.
Wow. Okay, so every time MKTX succeeds in capturing more volume in portfolio trading, which we just established is a major growth area and something they need to do, they're simultaneously accelerating the decline in their overall blended fee per million. They're kind of caught in this difficult dynamic where volume gains are structurally lower margin.
It's the definition of a Red Queen's race, right? They have to run faster and faster, generate more and more volume just to keep revenue potentially flat because the profitability of each transaction is consistently being compressed by this mix shift. Now, the business remains highly profitable, let's be clear. We're talking a trailing 12-month net profit margin of 26.6% as of June 2025. That's still fantastic. But the trend is unambiguously negative. Their gross profit margin has compressed significantly. It fell from 72.3% in 2020 down to 62.3% in 2024.
Big drop.
Yeah. And returns on equity are also down from nearly 35% in 2020 to just over 20% in 2024. The quality is high, but the returns are clearly diminishing because of the structural fee pressure.
Okay, I really understand the pain points now. The market structure itself, driven by this relentless push for efficiency, is basically cannibalizing their premium product, the traditional RFQ. This brings us squarely to the strategic pivot. When a high-quality company faces a structural challenge like this, not just a cyclical downturn, leadership changes often follow.
Exactly. That's why the new team is often called the wartime leadership team. Chris Concannon, who used to run Bats and SIBO, became CEO in April 2023. His entire background is modern electronic exchange technology speed, automated trading systems. That's the necessary shift in focus. And critically, they also brought in Carlos M. Hernandez, a 37-year veteran from JP Morgan as chairman in January 2025. He brings invaluable sell-side dealer expertise. So now you have this combined leadership that understands both cutting-edge electronic trading and the entrenched relationship-driven needs of the dealer community.
Okay, so let's unpack this three-channel offensive strategy they've rolled out. How are they fighting back against this workflow integration challenge and that FPM squeeze?
Well, the strategy is basically about aggressively attacking the areas where they previously lagged or maybe didn't focus enough. The first channel targets the really high-value, complex end of the market, client-initiated block trades. These are the largest, most high-touch trades. Estimates are that a staggering 46% of all trace volume is still done manually, often over the phone.
Why? Because traders are scared of moving the market with such a huge order.
Precisely. Fear of market impact. So how does MKTX convince a trader to move a huge multi-million-dollar trade onto an electronic screen? You have to overcome that risk aversion.
How do they do that?
They overcome it with data, with confidence. They're rolling out something they call targeted RFQ. This leverages their proprietary data assets, that CP plus pricing engine we talked about, and another tool called the tradability score. These tools basically tell the client, before they execute, exactly where the best liquidity likely is for that specific bond at that size right now, and the probability of execution success. This provides the pre-trade confidence needed to actually hit the button on those large electronic orders, knowing they've minimized the risk of adverse price movement. They're using data to de-risk manual trading.
Okay, that's the high end. The second channel addresses that low-fee growth area we discuss, portfolio trading. This is where TradeWeb currently dominates.
Right. So MKTX has committed heavy investment into their X-Pro interface. The goal is to make their portfolio trading capabilities best in class, focusing on speed, efficiency, and seamless integration. They had to catch up quickly here, and the results, well, they suggest they are gaining some real traction. Total average daily volume, ADV, in portfolio trading increased 69% year over year in Q2 2025 for them. Furthermore, they hit a record 22.5% market share in U.S. credit portfolio trading back in September 2025. That's a tangible win against TradeWeb in that segment.
Okay, that's progress. But if these portfolio trades are structurally lower margin, is capturing 22.5% market share really enough to stabilize the overall fee per million pressure?
That's the key question. That's the execution risk. It definitely helps stem the bleeding in market share, but it probably won't reverse the overall FPM decline on its own. It simply means they're competing more effectively now for that lower margin but growing volume. They really need to find a new, potentially higher margin revenue pool. Which brings us to their third and perhaps most disruptive channel, the dealer-initiated channel.
Okay, this is the launch of MKTX back in August 2025. This sounds like an entirely new market segment for MKTX, right? Focusing specifically on dealer-to-dealer flow.
Precisely. Historically, MKTX was almost entirely focused on dealer-to-client D2C trades. MKTX is a brand new trading protocol designed specifically for the dealer-to-dealer, D2D market. It's intended as an anonymous venue for dealers to manage their internal risk and their inventory flow. Think about it. When a bank buys a massive block of bonds from a client, they need to quickly offload some of that inventory risk to other dealers or hedge it somehow. That is the interdealer risk and inventory flow. And MKTX is now making a direct play to capture a piece of it.
Okay. So if MKTX's open trading was kind of like the dating service connecting investors and dealers, MKTX is more like the anonymous wholesale market, where the dealers can quickly and efficiently manage their own balance sheets amongst themselves.
That's a pretty good analogy, actually, yes. It's a totally new pool of capital and activity for MKTX. It shifts them from just facilitating client trades to actually helping the dealers manage their fundamental systemic risk. This is a high-stakes, high-volume market that MKTX previously just couldn't access.
So if you look at this whole strategy, holistically targeting the high-value blocks, boosting portfolio trading, and now adding mid-X, it really looks like a barbell approach to growth, moving away from that crowded, shrinking middle ground of standard RFQ.
That's exactly right. They are simultaneously attacking the highest value, most complex, high-touch, and the block trades using data to build confidence. And they're attacking the highest volume, efficiency-focused, and the automated AutoX and portfolio trading flow. They're trying to reposition the entire business to address the market fragmentation they perhaps ignored or at least under-resourced previously.
But doesn't launching mid-X risk competing directly with the same dealers that MKTX relies on for liquidity in its main Open Trading platform? Isn't there a channel conflict there?
It absolutely introduces execution risk. And yes, potential channel conflict, no doubt about it. However, the dealers themselves need efficient ways to manage their risk, especially given those post-2008 capital constraints we discussed. If MKTX provides a genuinely superior, meaning more anonymous, more capital-efficient venue via MidX, the thinking is the dealers will use it out of sheer necessity. Even if it introduces some competition to their own legacy inter-dealer systems or relationships, it's a calculated gamble, basically, that efficiency will ultimately trump tradition and existing relationships.
Okay. We also see the continued emphasis on product and international expansion playing a role here, too. You mentioned emerging markets debt. That market is actually larger than the entire U.S. credit market,
Right.
and with far lower e-trading penetration.
Exactly. That represents a huge greenfield opportunity for growth outside the hyper-competitive U.S. market. And their expansion into new asset classes shows resilience, too. They're making major inroads in the U.S. Treasuries market, for instance. Rates commission revenue is up 40% in Q2 2025. This diversification is important. It means that even if U.S. credit share stabilizes at a somewhat lower level than historically, MKTX has other significant high-growth opportunities elsewhere that could potentially pick up the slack.
Okay, so when you're analyzing a company facing these kinds of structural challenges, the valuation becomes absolutely crucial. It reflects the market's current assessment of MKTX's chances of actually pulling off this pivot successfully. And the market has, well, absolutely punished MKTX stock.
Oh, yeah. The stock has undergone a really dramatic valuation derating. Its current price-to-earnings ratio is hovering around, 28.7x. To put that in perspective, that is far below its 10-year historical average PE, which was closer to 48.7x. And it's an absolute canyon away from its pandemic peak PE, which was over 71x back in 2020.
So the market has just unambiguously downgraded MKTX's growth expectations.
Completely. And if you compare MKTX's current PE, roughly 29x, to its primary rival, TradeWeb. TradeWeb trades in the 41x to 42x range. That significant valuation gap reflects the market's pessimism about MKTX's future growth relative to TradeWeb. MKTX is currently priced like a structurally challenged, slower growth incumbent, despite its, high-quality underlying asset base.
But this is where the underlying quality of the franchise really shines through, isn't it? They are fundamentally an asset-light technology platform. They generate massive amounts of free cash flow, something like $8.72 FCF per share in 2024. And they have a pristine balance sheet.
A very robust balance sheet, over $620 million in net cash, zero outstanding debt. This is the ultimate competitive cushion. That financial flexibility means they can actually fund this aggressive, probably expensive strategic pivot, all the new technology for X-Pro, developing MidX, the international expansion, without having to take on external financing or worry about servicing debt.
So how exactly are they allocating this significant capital pile? What are the priorities?
Their priorities seem pretty clear and disciplined. First, organic investment, fueling those technology upgrades like X-Pro and building out MidX. That comes first. Second, strategic M&A, like that recent acquisition of a majority stake in RFQ Hub in May 2025, which enhances their execution capabilities in Europe. And third, shareholder returns. They have a strong track record here, 14 consecutive years of dividend increases, which showcases consistency.
And those opportunistic share repurchases, they tell an interesting story about management confidence versus the market's skepticism, right?
Yeah, they really accelerated the buybacks when the stock price dropped sharply. They repurchased $80 million worth of shares in just the first 7 months of 2025 alone. Management is essentially stepping in, using the company's strong cash flow, to signal to the market, hey, we think the stock is intrinsically undervalued at this price. This provides crucial price support and also enhances future earnings per share growth through a lower share count.
Okay, so for you, the listener, who's following this fascinating electronic fixed income war, what are the key risks you really need to monitor as MKTX tries to execute this turnaround?
Well, the primary structural risk remains competition. Can they actually stop the bleeding? Continued market share erosion in U.S. credit and that unyielding downward pressure on the fee per million, FPM, due to the negative protocol mix shift, those are the absolute core concerns. If FPM continues to fall at the current rate, the entire financial model fundamentally changes for the worse.
And then there's just massive execution risk tied to the strategic pivot itself.
Absolutely. These new initiatives, targeted RFQ for blocks, Mid-X for dealers, the portfolio trading enhancements, they are mandatory for success, no doubt. But they have to gain sufficient client traction and volume, and they have to do it relatively quickly. If they fail to execute effectively on the strategic pivot, the stock could just remain trapped in a slow growth environment. And that current low valuation relative to history might just become the new normal, a permanent reset.
And finally, there's the universal risk facing pretty much all exchanges and trading platforms.
Macro risk, yeah. Their revenue remains highly sensitive to overall trading volumes and market volatility. While volatility often increases trading volume, which can be good, a sustained slump in new credit issuance or a real market freeze-up that could dampen activity significantly. And that would immediately impact their top line, given that 87% reliance on commission revenue.
Okay, so synthesizing all this, what does it really mean for you, the listener, today? We've got this high-quality franchise, a true pioneer benefiting from an unstoppable secular trend electronification. But it's clearly facing a major, aggressive, competitive fight from entrenched rivals like Bloomberg with its terminal dominance and specialized innovators like Tradeweb with its workflow integration.
Yeah, we can really boil down the investment thesis into two opposing viewpoints. The bull case argues that the current valuation is just a cyclical hiccup. It's a rare entry point for a high-quality, long-term compounder. The argument goes, the new leadership is making all the right strategic moves to attack the market fragmentation, and that strong balance sheet provides the runway needed for execution. Eventually, this will restore the premium valuation.
Okay. And the flip side, the bear case.
The bear case suggests the competitive moat is perhaps permanently impaired. The sustained margin compression from that FPM decline means MKTX has fundamentally shifted. They're no longer a high-growth disruptor, they're now a slower growth incumbent. In this view, premium valuation is gone for good, and the stock risks becoming a value trap, looking cheap, but perpetually disappointing investors who are looking for those historical growth rates and returns.
So to decide which thesis ultimately wins out, what are the key things you need to watch?
You need to monitor three critical metrics going forward. Look for them in their monthly volume reports and quarterly financial results. First, look for the stabilization, or ideally an inflection point, a turnaround, in their U.S. credit market share. Stop the bleeding there. Second, watch the fee per million, FPM, very closely. If this metric stabilizes, let's say above $145 or so, the core profitability concern lessens significantly. And third, track the adoption rates and volume growth of those new strategic channels, specifically Mid-X and the targeted block trading solutions, because these represent potential new, maybe higher value revenue pools that could offset the pressure elsewhere.
Fantastic analysis. This has really been a true deep dive into the electronic fixed income war,
Okay.
really focusing on the battle for the future of bond trading and MarketAxess's place in it.
We focus heavily on the execution dynamics, the platforms, the market share. But maybe the final provocative thought for you, the listener, is this. The competition has fundamentally shifted, as we said, from just a fight for volume to a fight for workflow. MarketAxess has arguably the superior proprietary data assets. CP+ is incredibly powerful and deep algorithmic execution tools like AutoX. We often focus intensely on execution speed, on liquidity volume. But maybe the crucial question for the future of electronic finance is this. Does a superior AI-powered data asset combined with deep workflow integration ultimately prove to be a more durable, more unassailable competitive advantage than sheer, perhaps more easily replicated liquidity volume alone? How valuable is the intelligence that MKTX provides before the trade, even if the price of executing the trade itself is getting compressed? Something to chew on as you watch the next set of earnings come out.
An excellent provocative thought to end on. That's all the time we have for this edition of The Deep Dive. We'll see you next time.